Business owners, if your business partner, director, or key employee passed away tomorrow, your bank could call in your company loan immediately. Loans that you have taken to grow the company where you have signed surety on your personal capacity for those loans. Without the right kind of protection, your family or business partner can be left scrambling to repay those loans in event if something happens to you. In South Africa, we have protection to ensure that those debts are paid if something happened to you as a business owner or your business partner, protecting your family assets, protecting the business, and allowing for business continuity. In this video, I'm going to break down exactly how that works. So if you're a business owner, if you know of a business owner, be sure to share this video with them. Hi, my name is Yolanda. I'm a wealth advisor. It is my goal on this platform to give you easy, actionable tips, content, and strategies that you can use to manage money well, to live abundantly, and build generational wealth. I'm the founder of this platform, Financially Fabulous Females. I'm also the director of Solomon Wealth Management. We are a boutique wealth management firm based in Durban, and we help South Africans all across the country, even South African expats, get their money right. So if you would like to chat with me one-on-one, please click the link where you're watching this video in the video description. You can book a 15-minute complimentary appointment. Did you know in South Africa, almost 50% of small businesses don't make it to their second year? And only a tiny fraction of those businesses survive to the 10th year. And even more concerning is that many thriving businesses will shut down once their founders step away or pass away, because there was no plan for survival and succession. This isn't just about individual businesses closing their doors. Every time a small or medium-sized business closes its doors in South Africa, jobs are lost, families are affected, and our economy takes another knock. That is why I have set up this video series called the Business Succession Series to help South African business owners just like you not only survive, but builds a business that thrives long-term, outlives their founders, and builds legacy and generational wealth. Because the stronger small and medium-sized business sector we have in South Africa, the stronger South Africa is. In this series, we'll unpack tools, strategies, and structures that you need to future-proof your business. From risk management to succession planning to building wealth that lasts long after your lifetime. And if you are serious about turning your business into a legacy, this video series is for you. So make sure that you are subscribed to this channel. Also, make sure that you're watching the entire playlist. This is just part one of a long series that I'll be building to help South African business owners. Let's start with the basics. Contingent liability. This is an important word for you to know as a business owner. This is a debt or an obligation that kicks in when certain criteria is met. For example, your business takes out a loan. You as the owner or the director, you sign as surety. You use your personal capacity to back up this loan. So the bank knows that, okay, if this business can't pay, Mr. So-and-so or Miss So-and-so on a personal capacity is going to repay this loan. And on your personal capacity, you have your home, you have a couple of investments, you have something to back up your business loan. If you're alive, you're running your business, there's cash flow, everything is going well, the bank is happy. But if you pass away or become disabled where you can't work in your business anymore, cash flow is struggling, you can't repay back the loan, now it's a problem for the bank. And then the bank can demand immediate payment. If you're not around, they demand it from your estate. They can even demand the loan be paid back by your family. That's where contingent liability cover steps in. It's a life insurance policy that's taken out on your life as the business owner, specifically to cover those debts. So your loved ones are not stuck paying back business loans that they had nothing to do with. Let's be real, as South African business owners, we use our personal assets as leverage to access business loans in order to grow our business, to get some cash flow, because hey, jobs are scarce. Use your house to use your investments, maybe your spouse's signature if you married COP. But without contingent liability cover, if something happens to you, creditors can come knocking on your estate's door, on your spouse's door. And this could mean that heirs would be forced to sell assets that you have left behind in order to settle the debt. Or even worse, the business could collapse. A business that's providing your family with cash flow. But with the right kind of cover, the loan can be paid off, business can carry on trading, and your family keeps their inheritance intact. So how exactly does this work? So the business in its entity will take contingent liability cover on your life. The business will pay the premiums. If you had to pass or become disabled, the insurer will then pay the business the business has a cash lump sum to settle the various debt. This way, you create a wall between your business and your estate. Your estate is protected. Business can start moving forward without that financial loss. Now let's talk taxes, because SARS has to get a piece of this pie. If the business owns the policy and pays the premiums, this life cover amount stays out of your personal estate. So no estate duty is payable. The premiums are also not tax deductible. There's no capital gains because it's a risk-only policy, not investments. And because the proceeds go directly to settling the debt, you bypass executive fees as well. That's a big win. So there's different ways to structure it. Here's a couple of ideas on how you can set up your contingent liability. One, you set up the policy within your business, where the business is the owner, the business is the payer, the business is the beneficiary. This is ideal for long-term continuity of your business. The second one, especially if you're still a startup, this is one that you would start with and then branch off into specialist contingent liability cover, is where you take your personal cover and you cede it to the bank or whoever it is that's loaning you the money. After the debt is paid, the session is cancelled, right? I don't recommend this one because usually when we take personal life cover as business owners, we do it for provision for our minors and our families, right? So keep business and personal separate. Look at standalone contingent liability cover for your business. Remember, this is something I can help you with. We will take a look at your business, see where your debts lie. We'll look at how we can help you structure this in the most efficient way to ensure continuity of your business and your business is protected. Contingent liability is a very powerful tool, often overlooked. And if you look at business statistics in South Africa and how things are just closing, small businesses particularly, and I know the business environment is not the best, but there are various layers of protection that we can use to protect ourselves. Firstly, contingent liability protects your estate. If you, as a business owner, you pass away unexpectedly, your personal estate may be called on to settle your business debts, especially if you sign surety with the bank. With contingent liability in place, your debts will be cleared on your business, protecting your spouse, protecting your children, protecting the legacy that you leave in your personal capacity for them. Example, Thabo owns a construction company. He signed surety for 3 million to the bank to get a business loan to grow his business. Without any contingent liability in place, his estate would be responsible for paying back the loan to the bank, forcing his family to sell personal assets to settle this debt. With a contingent liability policy in place, the debt will be paid upon Thabo's passing or disability, keeping his legacy intact for his family. Secondly, it ensures that creditors are paid, not just the banks, also your suppliers of your business, even investors as well. This maintains a good relationship and protects your business reputation and your legacy. For example, let's say you have a manufacturing business. Your suppliers around 800,000 Rand, you've got this 30-day revolving credit agreement going with your suppliers. Something happens to you and you can no longer fulfill the loan, whether you pass or pick up a disability that prevents you from working. Contingent liability will settle the debt, 800,000, to your suppliers. If you have investors, they know that contingent liability can protect that investment if you are not around to fulfill that business mandate. This would prevent legal action against your family and preserves trust with your suppliers in case other family members are involved in the business and they want to continue operating the business. Third, it keeps the business afloat. Remember that without contingent liability cover, all of the debts become immediately payable when you pass, particularly if you sign surety anyway. Contingent liability is a liquid cash injection into your business, allowing the survivors to settle the debt. Creditors are paid. Let's say Lerato had an overdraft facility of 1 million Rand for IT consulting business. Lerato passes. Bank wants the money back. Now, contingent liability would pay the funds directly into the business account, allowing for that debt to be paid and business to continue until a new director steps in. Having contingent liability in place will also avoid liquidity of assets. One of the biggest risks is being forced into liquidation because you do not have cash flow in the business when big debts become due. Or you don't even have that lump sum to be paid when big debts become due. Then you'll be forced to sell, or your survivors will be forced to sell business assets, often below cost, in order to meet that debt obligation. Contingent liability provides that cash injection to ensure that this doesn't happen. Your assets stay intact within the business. For example, a family-owned trucking company will be forced to sell the truck that brings in the income to settle debt. Contingent liability ensures that that loan is settled. The business continues and runs smoothly, providing a legacy and cash flow for your family. A lot of the times, the banks require this. However, I have seen in a few cases where banks are not requesting it. However, it's your duty as a business owner to know about this, to protect every time you borrow where you're owing people money, put a layer of protection in place. I would recommend business owners to have one floating contingent liability. Never leave it closed, because something will always come up. You buying new machinery, you taking out new loans, you getting more investors. So the level of the contingent liability cover will fluctuate up and down as you take on more debt and as you owe more. Let's say SIPO takes a 5 million rand expansion loan. The bank would require contingent liability cover before approving the loan. This would give both the bank and SIPO peace of mind, knowing that one, the bank would get their funds should something happen to SIPO, and SIPO would know that his personal estate will be intact, knowing that his debt will be covered by a simple contingent liability policy. So I know as a business owner, you're thinking of just getting to business and start making some cash, but planning in these protectionary layers into your business is very important for a thriving, successful, legacy lasting business. The important things that you got to put in place is the structure of this, right? This is where a financial advisor will come in, do an assessment of where you are in your business journey, and give you the best advice on how you should be structuring the contingent liability policy. You got to pay those premiums and not let that policy lapse. That's another thing. Remember that as your business expands, as you take on more debt, as you get investors, your supplier, a revolving credit, and things start increasing, you need to adjust your contingent liability loan accordingly. You can't be sitting with a 1 million contingent liability, but your creditors are being owned 5 million, 10 million, right? Fluctuate your contingent liability accordingly to make sure that you are protected to the maximum. Remember, these few things that you don't get right can defeat the purpose of actually having a contingent liability in place. So make sure your contingent liability matches the loan amount. Keep your ownership documents on the policy, okay? Because if you are paying this policy from your personal account, this can form part of your personal estate, which you don't want. Review this annually with your financial advisor. Remember, it's financial advisors that can give you this cover. And don't mix this cover up with other sort of business covers like keyman cover or buy and sells. Keep it all separate. So there you have it. Contingent liability is one of the most powerful, unspoken about, unknown about products for South African business owners, and is so underutilized in South Africa. This is one of the tools that you need in your business arsenal to protect you, to protect your legacy. If you found this video helpful, be sure to give it a thumbs up. Remember to stay subscribed for more on the business succession series, and be sure to share this video with other business owners that need to know this information.